All right, everyone. Welcome to week 8. Today's agenda is the following. I'm going to go over last week's quiz, and then our goal for today is to figure out how to analyze two types of policy. Number one is monetary policy, and the second is fiscal policy from the new framework that was introduced to you last week, right? The AA and DD schedules. So let me quickly go over the quiz. So just like the last quiz, I think all of you understood pretty much everything, and only maybe like a handful of you got less than 3 points. So let me just read the questions to you now. Which of the following choices best describes the effect on consumption, investment, and net exports that would result in an increase in the price level, other factors held constant? All right, so we're trying to see what happens when you increase price and how that impacts consumption, investments, and exports. And if you understood the GNP equation or GNI equation, you know that consumption is a function of disposable income, net exports is a function of the current account, which is a function of Q, which is a function of prices. And then you just have to think about how changes in prices impacts those inputs, given the parameterization that we did last week. So for consumption, we know that as you increase prices, that's going to decrease your ability to consume your disposable income, and therefore you have to consume less as a result of higher prices, right? So just given the choices we have here, A is definitely wrong because it says increase. So B is the only other, B and C are the only other candidates. And so let's move on. Investments. If you have an increase in price levels, then for some things such as asset prices, right? If certain assets tangible assets becomes more expensive, then it's harder to make those investments. If that doesn't make too much sense, don't worry. We can always look at the last choice, right? So if we look at net exports, we know net exports is a function of the current account, and therefore it's a function of Q, right? And we know Q is EP star over P, and we know that prices appear, right? Domestic prices appear in the denominator. And when you have prices in the denominator, when you have it increasing, that's going to actually make Q lower, right? Of course, assuming that that condition holds, right? That allow us to conclude that the relationship between Q and the current account is positive. So we typically assume that, all right? And that requires just that derivative that we talked about last week, which we'll go over one last time next week. So based on that understanding of the relationship between Q and CA, you can conclude that when price levels increase, Q decreases, and as a result, the current account is going to decrease. And therefore, compared to B and C, exports, right, is going to decrease and not increase. So just based on your understanding on how we parameterize consumption and how we parameterize net exports, right, C is the superior answer. And we didn't talk much about investments, but again, the idea is you should think about investments like physical capital, factories, machinery, all those things. If average price levels were corresponding to those tangible assets, those physical assets, then it's going to be harder for you to make those purchases, right? Those acquisitions, and therefore, manufacture certain things requires higher capital, more capital, in other words. Okay, so that's question 1. So I think almost everyone got that question correct. All right, question 2, which of the following factors is most likely to increase aggregate demand? So a review of what aggregate demand, how it's parameterized, right? Demand is a function of Y minus T, I, G, and of course, Q, right? And all we have to do is look through A, B, and C and see how changes in, any of those parameters appear in A, B, and C and how that changes D. All right, so A, increase in real interest rates. Okay, so we know, for those of you who have the background, I is it going to be a function of real interest rates. And the idea is that if you have higher interest rates, then it's going to be harder for you to choose to make investments because your opportunity cost of making that investments is much higher now, right? Because you can, rather than try to make higher returns with more risk, you can just put your money in higher interest rate returns and in safe assets, and that your decision is going to actually so increasing the real interest is going to undermine your aggregate demand, right? So that's the idea. So I talked about a little bit about this last week, but if not, just know that there's a negative relationship between real interest rates and investments. And so if you have higher interest rates, that's going to decrease investments, and that's going to decrease aggregate demand. So that's this question for A is wrong. All right. B, an expected decrease in future prices. So where does prices come in? Prices come from, I guess you can think about it in two ways, from disposable income and also from Q, right? So if you have higher prices for the same level of consumption, then you're going to have to, cut your spending, right? You're going to have a budgetary problem and therefore not enough disposable income to meet the same level of consumption. And that's going to decrease demand, of course, right? From consumption point of view. Of course, you can also think about it from Q perspective, right? Q, again, is equal to EP star over P. If you have higher price levels, that's going to decrease this overall expression, right? And therefore, Q must decline. And as you know, there's a positive relationship we typically assume between Q and the current account. And as a result, we should expect aggregate demand to decrease. So either through consumption or through import-export competition, right? B is giving us the opposite direction of what we want, right? Which is increase in aggregate demand. So B is not the answer. So just based on the process of elimination, C is the answer, but we can double check why that's the case. C states an increase in real wealth. So another way to say that is disposable income increases. And obviously, we know there's a positive relationship between disposable income and aggregate demand, and that's going to obviously increase D, right? And so C is the best answer. All right, so that's just testing if you are following my explanation of how to parameterize aggregate demand. And of course, it's all in the slides. All right, last question. When national income in an important trading partner's economy increases, aggregate demand in the domestic economy is most likely to which of the following. So national income of an important trading partner. So we're talking about disposable income of our of someone else, right? Y minus T star, right? Talking about that. So when our trading partner becomes wealthier, they're going to boost, that's going to boost their demand, obviously, right? And that means more consumption, perhaps from imports, right? So it could potentially drive our exports somehow. All right, so whatever I just described to you is A, right? Increase because foreign consumers will tend to buy more export goods from domestic countries. So it's just thinking about the subsequent logic that follows because of someone else having more income, right? Rather than ourselves that boosting aggregate demand, you can think about other people getting wealthier and buying more things, and part of that additional income is most likely will trickle down to their trading partners, such as us, right? The domestic country. All right, so let's look at B and C just to make sure that we're not crazy. Decrease because foreign consumers would tend to buy less export goods. Well, that's not what we typically think about people with additional money, right? We think of them having a increasing utility from having more wealth, right? And they're going to go seek out to buy more things with more money, right? This is an obvious. I think, well, it's intuitive, right? It's I think we all agree that's the case when it comes to money and wealth. All right, and C, decrease because interest rates in domestic economy will tend to increase. I think this is supposed to be for the foreign economy, not us. So actually nothing should have happened. We typically assume that domestic interest rates has nothing to do with foreign interest rates. It's totally unrelated things. But if you replace domestic economy with foreign economy, then C would be the correct answer, but it's not. Okay, so C is wrong and B is wrong. And I hope you can see that, right? If I replaced, if we increase wealth, right, you see an outward shift of the liquidity preference curve, right? And that's going to increase R, right? So if that increase in Y is coming from domestic economy, then yes, right, I would agree that interest rates will even the direction is wrong. So that's right, increase, yeah. Okay, so anyways, B and C is wrong, and my small minor point is that if you replace domestic economy with if you replace this increase in wealth coming from the domestic economy as opposed to foreign economy, then C could be right, but its statement is totally false. Okay. All right, that's question 3. Comments, questions. So I hope this is straightforward. Again, I pulled these questions directly out from a CFA test prep book. So I didn't write these questions myself. So if you have any questions and comments, let me know. Okay, that's it for the last week's quiz. And so before I jump into today's task, let me just briefly review a little bit about what we did last week. Yes. All right. So what did we do today? Last week. So last week I introduced the new objective here was to find our model to price foreign exchange rates, foreign currencies, and try to link it with the real economy, right? We've already mission accomplished with the financial aspect. We thought about the opportunity cost of holding on to cash, which is riskless debt coming from the money market, right? And also from the FX market coming from the incentive to arbitrage interest rates, either that or through carry trade, right? As long as you have risk neutral investors, then they'll always come in and try to equilibrate or equate the left-hand side with the right-hand side of the UIP equation. All right, so that's the financial aspect. They're very reactive. They incorporate information. They have expectations, right, in the equation, and the things are, responds very fast to changes, updates of new macro news, etc. All right, but something was introduced to you last week that's new, which is this way to link the macro economy with foreign exchange rates, and we know where that comes from. It comes from the Y parameter in the money market equation and the liquidity demand preference function, right? And so what we did is we parameterized it, right? We thought about what component is relevant: consumption, investment, government spending, as well as net exports. And we also thought about what conditions we need to impose so that we can conclude that there's a positive relationship between the real exchange rate and the current account, which is our measure of import-export. All right, and then we summarized these markets into 2 fundamental equations, right? UIP plus money market is coming from this equation now, right? It's coming from this equation here. Again, all we're doing here is just taking the money market equilibrium, replacing the R, the interest rate, with UIP, and we arrive at this equation here, right? So this equation is a representation of all financial markets, and financial markets clear. In other words, when things are stable and nobody has incentives to do anything else, and money supply equals money demand, all these equations must be true. They must equate. Okay, left-hand side must equal the right-hand side. So that's represented by the AA schedule that's downward sloping. So again, we're using the AA schedule and the DD schedules in this fashion because we want to understand the relationship between E and Y, right? This is what we're plotting against. We want to know the relation, how E can affect output somehow. And this is important because governments and developing economies care about how they can influence total output of an economy through exchange rates strategy, essentially, okay? And that's what we're trying to do today. So by introducing to you the aggregate demand function now, in other words, parameterizing Y in a certain sense, we can understand how governments can also influence the exchange rate and therefore influence output. Right? That's the objective today. We want to understand how fiscal policy affects output and its secondary effects on the exchange rate. Okay, that's our objective today. All right, so we represented this real side of the economy with this equation here. And it's a very simple equation which relies on a potentially empirically wrong understanding of how the economy works, but it's sufficient for modeling purposes, right? From a macro perspective, from a mathematical modeling perspective, we're never trying to capture the entire market in its most accurate form. Okay, we want a good enough model so that we can somewhat understand the mechanisms, but allow us to draw reasonable predictions about the relationship between certain variables. Okay, and this is represented by y equals a d function, right? The idea is that demand has various sources of input, and changes in those inputs will change demand, and there will always be supply that's coming to meet the change in demand. Okay, so that's the underlying mechanism here. Right, so if you buy that mechanism, then so long as we know which parameters are changing, we know that eventually the market will clear itself. Okay. And so when we plot the DD schedule and the A schedule on this graph, E versus Y, total market clearing occurs when those two lines intersect. And the reason is because the DD schedule is a representation of all possible combinations of E and Y that gives us market clearing, right? Same thing for the A schedule as well, right? All combinations of E and Y that gives us market clearing in the financial markets. And so when you choose an E and Y in which are both on the A schedule or line and the DD schedule, then we have market clearing everywhere, right? And that's going to be our stable equilibrium, okay? In other words, nobody has incentive to make any more goods and services or cut certain goods and services. Nobody wants to conduct carry trade, and supply of credit equals demand for credit, so forth. All right, so how does market clearing, what's the mechanism that allows us to clear both of these markets, right? The financial markets and the real economy. So in this slide 21, I briefly walked you through last week the mechanism we economists typically think through ourselves. Okay, so to understand what goes on, we usually say, suppose there's an irrational change in the equilibrium to some point that doesn't make any sense, and then we think about what should happen next. So in this case, I introduced to you an unstable point here as we move from this initial starting point to this starting point here, and we kind of discussed what should happen first. And the logic I've already outlined here, so let me just briefly discuss how that works again. So once we are in a stable point here, we notice that this point is not on the A schedule and is not on the DD schedule. And because, as I mentioned earlier, all the information is going to be absorbed first, is going to be taking place in the financial markets. And so what's going to happen first, given this E, is that the traders are going to react to that information first, right? And so when you have an E value, what's going to be distorted first is UIP. When UIP is distorted, you'll have carry traders come in. They're going to borrow low interest rates, lend out high interest rates, and that's going to immediately change the E value to a value that's going to be on the AA schedule. So if we are here, notice that for this combination of E and Y, what we're doing is holding Y fixed and saying that E is up here. And with that value of E, that's UIP is going to be violated for sure, right? Because it's not on this line. So the first thing that happens is this point is going to be dropped onto this line, right? Okay, so what that means is like, so you have R equals R star plus E hat E minus E over E, right? And we are at a E that's too high, right? So in other words, that's going to cause, that's going to be this way, right? You have an E that's too large for a given Y, and carry traders come in, right? And they push the E down in this case, correct? And they push the E down so that this entire right-hand side goes up, and so that we're restoring equilibrium. Sorry, equality. So that's why this point here drops onto this A schedule. So after that occurrence, things start to change in the real economy because the E is still relatively higher than the starting point E naught, right? The starting point is here. So with a higher E level, that's going to change aggregate demand, right? So we talked about this feedback mechanism last week, and I'm just reminding you, this is all working in the background. Even though all you really need to do to pass this class is to understand curve shifting and all so forth, but it's important to understand, I think, as accountants or people in finance to understand the mechanism here, right? The mechanism is with this higher E, the higher exchange rate or more devalued currency, that's going to create import-export incentives, right? Because with higher E, you get higher Q. That means foreign prices are more expensive. And with higher Q, that's going to increase aggregate demand. With higher aggregate demand, that's going to increase Y. All right. So, and then after that, the next step is this Y is going to feed back into the A schedule again. So what's going on is that this feedback is going to be represented by us moving along the curve of the A schedule, right? We're moving from this point here all the way back to here again, right? Because as you increase Y, the E value no longer has to be as high anymore, right? Again, we're on the A schedule, right? So that means that as you increase Y, the trade-off between E and Y is negative. So higher Y means E is lower now. So as we move from lower, so higher Y, lower E, the lower E is going to feed back into the aggregate demand function and so forth, right? So the cycle keeps moving over and over again. We're moving along the A schedule until every market clears, right? And that's exactly this point here. All right, so that's how you should think about how equilibrium is achieved across those two markets. All right, you have to think about if we're off, or if we're no longer on the AA or DD schedule, who responds first? After they respond, which market clears? If that market clears, what happens to the real economy? And changes in the real economy takes place, how does that ultimately affect the fundamental markets again? And it goes over and over again until we reach a final stable point, right? In which all markets are clear and demand equals supply, and carry traders have no incentive to conduct to borrow low and invest in high interest rates. Okay, so that was last week. All right, last week we defined AA schedule, we defined DD schedule. Again, I reminded you again that AA schedule, DD schedule is a collection of points of E and Y that achieves market clearing in either the financial markets or the real economy. And today we're going to be talking about shifts in the DD and AA schedule, and for both temporary and permanent policy changes. So just give you a idea first. So what we're going to do is try to combine everything that we've learned up to now. Okay, so even the absolute PPP condition, we're going to try to impose it when we can. But as you will see, that it's not always possible to make that assumption, that condition, the long-term condition, true. As we talked about, as we will talk about fiscal policy. As you will see, fiscal policy basically makes absolute PPP impossible to achieve. Okay, but for monetary policy, it is possible to impose the long-term condition in the long run. Okay, so remind you again, the long-term condition just says that Q, right, is a constant. We can achieve that assumption in the monetary policy, but not fiscal policy. So fiscal policy becomes tricky, as you will see. All right, comments, questions before I move on to this stuff. Okay. All right, so if you don't want to think about economics, incentives, and mechanisms, that's fine. You can just memorize this table, write this down somewhere. That's okay too. All right. This table, this slide basically tells you if certain parameters change in the aggregate demand function or in the AA schedule, you know which line to shift, either to the left or to the right or up and down. So DD schedule, I usually say left and right. AA schedule, I typically say up and down. So maybe I just tell you, give you the hint again, right? The hint is hint. If it's not on, if the variable is not on the axis, then the curve must shift, right? That's the intuition. So for the DD schedule, we won't talk about E and Y because obviously changing E is going to change Y, and all right, because of those are the two axes. So if we change E and how does that change Y, we know because it's positive relationship, and we're just moving along the curve. But if we change those parameters that do not appear on the axes, such as I and G and C, the current account function, or P star P or T, right? All these other parameters can have an impact on D, and that will require us to shift the curve. So let me just give you a preview really quickly, okay, of what's to come. All right, so assume that we're plotting a very simple plot. So I'm just going to go through really quickly. But again, the idea of shifting curve is just like shifting curves in the short-term model we worked with, right? When we're plotting E against R. So now it's just E versus Y. So the curve shifting logic is still the same. So if we have a initial DD schedule, so let's call that DD, and what this is describing here, let me just go through an example. So given E, so let's just fix an arbitrary E. If we decide to increase, let's just say government spending, we know government spending, for example, if the government decides to build a new park or university, right, that can boost incomes and therefore boost consumption and boost demand. Right, that's going to increase D, right? So that's going to distort this aggregate demand function in this fashion, right? Aggregate demand is going to exceed supply. And in order to restore this equilibrium, supply must meet demand. So as a result, Y has to increase. So on this graph, we should see this point shifted to the right, right? So the logic again, fix E, we change the variable that's going to be increase or decrease. So that's G. So here we have G increasing. D is going to be larger than Y. And based on Keynesian logic, Y will increase to meet D. And so the Y value therefore has to shift to the right. The choice of E here is arbitrary. So I could choose any E, right? I can choose any E. As long as G increases, Y has to shift to the right, right? Because it's getting larger. So in fact, the entire DD schedule therefore has to shift to the right. Right, so that's the logic, right? That's the mathematical logic. It has to be true. All right, so that's G, right? Another thing that another parameter that might change that's relevant to the DD schedule is taxes. So to give you again a preview of what's to come, taxes are a bit different than government spending, and the reason is if the government decides to cut taxes, which effectively is like a rebate, right? People will tend to save some of it. Okay, so just by that description, tax cuts are not as effective as just public spending to some extent, right? If you want to boost consumption, this is also a reason why Hong Kong decides to issue consumption vouchers as opposed to just giving people cash. Because people, if you give enough people cash, they'll just pool their money together and just buy a house. Right? That's not gonna help the economy. So you want people to use the money to spend. That's one way to stimulate. So government spending to some extent is probably more effective than tax cuts. All right, anyways. Tax cuts, right? Tax cuts is another way to increase demand by a certain amount. So sometimes I'll write delta T. Delta, I forget which parameter I use. AT, alpha T. So alpha T indicates it's the amount of taxes cut that's not saved. Okay, so that's gonna boost consumption. All right, so if I cut taxes, right, minus delta T, or I increase government spending, that can boost D, correct? And the logic is the same. So decreasing taxes is going to shift D to the right. Increasing taxes is going to shift to the left. Clear? Yes. So the logic is also the same for Q here, right? So if Q increases, that means export competition is lower because your domestic goods and services appear more competitive, cheaper, and everyone's substituting away from their own goods and for the domestic country's goods. That's going to increase demand. So for any chosen E, and for some reason Q increases either through P star or P, that's going to have a rightward shift at the aggregate demand function. Concur? So I hope the logic here with T and P and G is clear. All right. So let's also do an example with the A schedule. So the A schedule is downward sloping, and here the first bullet point states for a given Y, an increase in which of the following should shift A schedule north. Right. So let's walk through the logic. So fix Y. So let's go ahead and just fix an arbitrary Y. Sure. That's our Y. If we decide to increase, for example, money supply, that's going to distort this AA schedule equilibrium equation in this fashion, right? The left side is going to be greater than the right side. And we want to change E to some point that allows us to restore equality, right? So that means if we don't change P, then L function has to somehow increase. That's only possible if we don't change Y, if R decreases somehow, right? And that's only possible if E increases, right? If E increases, R decreases, L increases, restore parity. So for given Y, for any arbitrary Y, this point must be at a higher level. Again, to emphasize, this Y is chosen arbitrarily. So in fact, every point on the A schedule should shift up. And therefore the A schedule is at a higher level than before. All right. So the reason why, so some of you may have a confused look when I wrote CA and L here. So it's possible that the entire function becomes different than before. For L, I think it's straightforward. Just think about as a fat person, I consume a lot of things, right? Specific things that's perhaps junk food, right? But suppose the entire population becomes health nuts, right? Like, I don't know. It's possible, right? Then the inquired liquidity demand function, preference function is also different now. In that sense, that could change how they respond to additional income. It's possible, right? So if you think about that, then that can also have an impact on Y. right? Sorry, in this equality equations. So if L suddenly become more responsive, for example, to Y, maybe they all become more risk averse, something like that. That can distort the equilibrium, right? Same with the current account function. If a country becomes, again, prefers imports more than before, right? If they have a wealth shock such that they prefer luxury goods more than before, then it's possible imports matter, and that can have an impact on aggregate demand, something like that, right? So that's why it's written here. So it's not just the inputs. Sometimes the entire functions can change in such a way that you draw conclusions about how the magnitude in which D changes. Okay, so I'll write this down. Changes in CA and L can change the magnitude of changes in D, or magnitude of D, or L, right? In response to changes in input parameters, right? So an example that you might think it's relevant now. So when Ukraine was invaded, you can think about how that impacts the liquidity preference function, right? Yeah. So when Ukraine is invaded, people definitely became more demand liquidity over anything else, right? And yeah, and that's how it's relevant. And you want to know how that change in liquidity preference impacts the exchange rate, right? So that all depends on your assumption of how sensitive L is with respect to R and Y. So the logic here is for Ukraine, if the liquidity preference change because of war, any level of interest rates most likely won't have any effect on L, right? Because nobody believes, perhaps nobody believes that banks in Ukraine are trustworthy anymore, right? So give you an example to think about these parameters. All right. All right. Comments, questions on how to shift the AA and DD schedules. So that explanation should already give you a starting point to think about how to understand fiscal and monetary policy from the perspective of the AA and DD schedules, right? So it's just, everything is just the same underneath the hood, right? Underneath the hood and behind the scenes, it's just like the examples you did with E versus R, and you should convince yourself that that's what's behind underneath the model, right? This is the same economic mechanisms, but now we're just thinking about E and Y, and how changes in that's going to feed back into the DD the DD aggregate demand function now. Okay, so that's the other additional layer that you think about now. Okay, so let's go ahead and think about a temporary change in policy. So we are going to start out with the most simplest example that we analyzed before, which is the change in nominal money supply. So we're just going to review. This is now just review. We're doing the same sort of analysis, but now with the AA and DD schedule in mind, as opposed to the UIP versus money market equilibrium. Okay, we'll talk about fiscal policy later, and temporary cases are easy to understand because we don't have to think about changes in expectations. Everything will be undone or reversed before we get into the long run, so there's no long run analysis whatsoever. All right. The underlying assumption that's has to be there to keep our analysis simple is that we assume that foreign interest rates and foreign prices don't influence domestic policy. So the decision for the US, for example, to cut interest rates has nothing to do with whether or not the EU or the Bank of England decides to cut rates. That's the underlying assumption. So we just take everything as a given. All right, so let me give you a preview of what you should expect for a temporary monetary expansion. So when we increase money supply, what you should observe is a temporary increase in output in the short term. And the logic is the following. You have excess money, which is only absorbed by the private sector if interest rates in the equilibrium is reduced, right? Makes sense. If you want people to hold on to more cash, you need to decrease the opportunity cost of holding on to that cash. And that's only, yeah. As a result, nominal exchange rate must depreciate. Yes, because lower interest rates means that domestic interest rates are less attractive, and so carry traders come in to borrow domestic and lend out or invest in foreign, and that requires converting domestic to foreign, and therefore domestic currencies are worth less than before. And ultimately, you get a depreciated real exchange rate, again, because of sticky prices. And that's going to make domestic exports relatively cheaper and foreign imports relatively more expensive. Yeah. And with sticky prices, absolute PPP is going to be broken. Yes, it's not going to hold. So that's the preview. So we can analyze this now graphically, and we'll go over it slow so that we understand the underlying mechanisms and where the feedback takes place and so forth. So for the exam, all right, if I ever ask you to analyze these things, the A and DD schedules, use a graph, etc., always, again, just like the short-term model, you always start with a initial equilibrium point. So that's what I'm going to do. So let's start off by writing drawing the A and DD schedules. We have a starting point here. And we will call that Y naught. And we will have a starting E naught. So to make things clear, let us write the equilibrium condition for the DD schedule as well as for the A schedule. D is disposable income, investments, government spending, and Q equals EP. That's right, EP star over P. And for the A schedule, it's the money market equilibrium. MS equals P times L, but now we replace R with R star plus E hat E. I'm going to write E hat E over E instead of the percent change, okay? And then Y. Okay. So that's our starting point, right? I just wrote out the equilibrium equations for the financial markets, the equilibrium equation for the real economy. And now I want to know what happens if I decide to increase MS, right? So let's go ahead and do that. We increase MS, money supply. That's going to distort the money market in this way, in which the left-hand side is now greater than the right-hand side. All else equal, if Y doesn't change for any Y, something has to change with R, right? So how do I equate left-hand side with right-hand side? Well, something from the right-hand side has to increase to the same level as the change in MS. So to increase L, I need to decrease R. And that's only possible if E increases, right? So every point on the A schedule should increase up, right? Because I chose Y, I fixed Y, right, arbitrarily. And for every point on the Y, if I have a higher MS, the E has to be at a higher level in order to restore equilibrium in the financial markets. So let's go ahead and just draw a higher line here. And you all know the mechanisms of why that's the case, right? If you have increased money supply, interest rates go down. That's only possible if that's only possible. Yeah, so that's only possible if interest rates go down. If interest rates go down, investors come in and conduct carry trade, right? And that's going to restore equilibrium, and that requires the entire A schedule moving up. That's the mechanism. All right, so based on this graph here, the next thing you should think about is feedback, right? So for a given y, now we're up here, all else equal. And we can just, I won't designate a point here because it's not that important, but at this point is going to feed here, right? And of course, we're going to assume a positive relationship between Q and CA. Okay. So with a higher E, that's going to increase Q, meaning exports is become we're more competitive in the exports because people will be substituting away from foreign goods and services in favor of domestic goods. And that's going to ultimately increase D, right? And then equilibrium is going to be distorted. Left-hand side greater than right-hand side, right-hand side greater than left-hand side. According to the Keynesian model, aggregate supply must increase to meet the demand somehow, right? So that increase in Y means that we are shifting this way, right? In other words, moving along this curve, right? So as Y increases, that's going to increase this Y. But with a higher Y, the trade-off is going to be with a lower E, right? So we're actually moving from this point here all the way down to this new equilibrium spot here. So I hope that's clear. So let me emphasize that again. So this, let me first point out, this is our short run equilibrium point. Maybe highlighted, maybe I just use text, right? Short run. That's the short run equilibrium. So meaning that if we have sticky prices, so another assumption, assume sticky prices. With sticky prices, with a positive relationship between Q and CA, this is going to be our short run equilibrium. So let me walk you through again why that's true. A central bank decides to conduct monetary expansion. That means they're going to print more money, and that's only possible if interest rates decrease, right? That's the only way this liquidity, extra liquidity, is going to be absorbed in the system if their opportunity cost of holding on to cash also goes down. With that, with lower interest rates, carry trade investors come in, conduct carry trade, and restore UIP, and that's going to devalue the currency to a higher level of the nominal exchange rate E up to here. So let's just call this, I guess, E prime, and let's call this E double prime. Okay, so up to E prime. All right, so for a given output, right, for Y naught output, we have a higher E prime. And the reason why E is higher is because carry traders are coming in and pushing, devaluing the domestic currency because they're selling domestic currency in favor of the foreign currency. But with this higher level of E, that E is going to feed back into the demand function and drive output. And the reason is because with higher E, the domestic country is becoming more competitive in exports because foreign goods and services are relatively more expensive than domestic goods. So that's going to boost the current account. That's going to boost aggregate demand. That's going to distort the real economy, equilibrium, because demand is going to exceed supply. Over time, Keynes says that supply will meet demand, fine. Y will increase eventually. But with higher Y, that's going to distort the A schedule again, right? Because we know there's a trade-off between Y and E. With higher Y, E doesn't have to be as high anymore. And so from this point with higher y, E doesn't have to be as high as E prime, right? So we have a lower E now if we decide to increase output to some point here, right? But as we continue to increase output, Y is going to continue to feed back into the money market equilibrium equation, and the E is going to continue to decrease until we're at a point in which the real economy clears, as well as the financial markets clear. The real markets and the financial markets both clear. And that's exactly at this intersection here. So from week 1 to week 6 or 5, we stopped at here, right? We just stopped at here, right? That's not the end of the story, right? Things are a little bit more complex, and we modeled that complexity to some extent with this aggregate demand function, and we realized, well, it's not actually going to be at E prime, it's actually be somewhere at E double prime, right? Because having a higher E is going to boost exports, and that's going to feed back into income. That income is going to feed back into the money market and change E further, right? Until all markets clear. So that's the logic here. And that's the difference between the analysis here versus the analysis up to week 5. All right, comments, questions on short-term effective temporary monetary policy. So on your own time, think about going the other direction, obviously, right? If a central bank decides to cut money supply, how does a curve shift? How does that impact E? How does E feed back into the aggregate demand function? How changes in that function changes real supply of goods and services, how that changes income, how that income feeds back into the money market equation, and so forth. All right, so maybe I will write the takeaway here. So increase in E will increase CA, and that's going to feed back into more money demand, right, from L, and that's going to decrease E, right? So that's this is the feedback mechanism I'm describing here, right? You have an increasing E, driving exports, creating more money demand here. So the user, let's see, this is referring to this part, feedback here, and E therefore decreases. So this is it's not a contradiction, okay? It's just recursive, right? Constant feedback until we reach a steady point. Okay. Pretty straightforward, I hope. All right. Fiscal expansion. As I said, it's a bit different because, as you will see, when you do fiscal expansion, it's actually going to undermine exports because it's going to make your currency stronger. So hopefully you see that. If I just give out, for example, handouts and I make everyone wealthy, so just imagine we're Hong Kong, I just make everyone wealthy, give everyone tax breaks now, and people are going to use that money to buy goods and services, and to some extent, people want to convert their foreign currency to Hong Kong dollars to buy more things. So the Hong Kong dollar is going to get stronger, right? That's actually going to undermine export competition, right? Because you want your currency to be weak if you want to make exports. But if everyone's wealthier, our currency is going to become stronger, and that's going to hurt exports. So there is a contradictory effect, right? There's an opposing effect with tax cuts, okay, and government spending. And my job now is to explain to you graphically and mathematically why what that looks like on the AA and DB schedules. All right, so let me talk about temporary tax cuts first. So a tax cut increases consumption, but also savings. All right, so that's why there's always it only partially raises aggregate demand, and not one for one. However, increases in government spending is going to increase it by the same proportion. So usually when, as I mentioned earlier, when I talk about tax cuts or tax increases, there's going to be a C part. I'm going to write in my notes, I wrote C. So I wrote alpha before, so I'm going to use C here. Okay. I'll write C delta T to indicate tax cuts, the part of the tax cut that people actually use to consume, right? So that's the proportion of the tax cut that people use to buy things, essentially. And then for government spending, I'll use plus delta G to indicate a government spending. All right. So just based on my description, you kind of already know what's happening, right? So Y is somehow increasing, but that increase in Y is going to undermine export competition through a stronger domestic currency. And I'm going to try to show you that. And then I guess the key takeaway that you'll eventually see is that we can't make relative PPP true in fiscal policy conditions. Okay. All right, so let's try to analyze that. So as usual, let's go through the full example with the starting equilibrium, write all the equations, and then try to figure out how a change in fiscal policy changes which curve and so forth. All right, so let's have a starting point here. Let's call that E prime. This one, Y dot. And let's write out the equilibrium equations. Y equals D minus T, I G, EP star over P. And the financial market equilibrium, MS equals P times L, R star plus E hat E over E minus 1. Fiscal expansion refers to two specific parameters. That's this one, the T, and the G. Okay. Examples of T is obvious, just tax cut by a given tax bucket. So if you want to help the middle class, you cut the tax on the middle class. Then in aggregate, of course, more disposable income. An example of government spending is, a government decides to build some infrastructure that help businesses, right? Like the internet. That's for those of you who are unfamiliar, how the internet came about, it's because of lots and lots and lots of government spending. Yeah, that's how it came about. Yeah, so think about that. Government spending, that can also have an impact on demand. Cool. All right, so what happened? So let's walk through an increase in, a decrease in taxes, right? So let's do decrease C delta T, and let's think about plus delta G. So if G increases or T decreases, that's going to increase D, right? For given E. So let's just choose E here. That's going to distort the real markets for goods and services in which demand exceeds supply. And in order to restore equilibrium, supply has to be created to meet the demand, right? So Y has to increase. So for a given E with an increase in G or decrease in taxes, this DD curve at this point should shift to the right, right? So again, I chose E arbitrarily. So if you choose any E, this one or this one, it doesn't matter. That point has to shift to the right in order to restore or clear the real economy. So the DD curve has to shift to the right. All right, so if that's the end of the story, then we should be here, right? But of course, that's not. So at this E and at this output level, let's just call this, I don't know, Y prime as a as the output here, this hypothetical Y will go into here, right? So now let's walk through the next steps after that. With higher Y, we have higher L. And that's going to distort the money market equilibrium that favors the right side over the left side, correct? So we need to find some way to make the right-hand side lower. That's only possible if we somehow undo this L, all else equal. Suppose we don't change prices. We're in the short run, so sticky prices. Sticky prices. That's only possible if interest rates change, right? So interest rates is this set of equation here, this equation here. And we know that there's a negative relationship between R and L. So we have to find some way to increase interest rates. And that's only possible if E gets smaller, right? So E has to decline in order to restore money market equilibrium. So what's going on? Well, what's going on is we're actually moving from this point here slowly along the DD schedule until we hit this point here, right? Y double prime. Right, so I hope everyone sees that sequence of logic, right? And it's not just one, it's not just two steps, it's infinite steps because it's just constant cycling of a change in E has a change in Y has a change in E, and then change in Y has a change in E, and so forth until everything stops, right? And when everything stops, then we have a equilibrium point. So the final market clearing set of equations is E naught and Y double prime. All right. So usually I will write this gap here represents a plus delta G because it's increasing one for one, right? If I increase G by 1 unit, then D increases by 1 unit, so it's plus delta G. Or I sometimes write minus C delta T. Again, it's called C delta T because we're only concerned about the consumption portion of the tax cuts that people use to change demand. If it's saved, then nothing's going to happen, right? So the takeaway here is that this potential output is not fully realized, right? And it's coming from the fact that the currency is becoming stronger. And so that appreciation of domestic currency, therefore, is undermining the effectiveness of fiscal policy under flexible exchange rates. So remember, we're still working in the framework, assuming we have a global set of countries that don't manipulate currencies and have targets here, where they just let the currency float, essentially. Under this assumption, you can tell based on this graph that fiscal policy is not ideal, right? Because it undermines exports. So one possible way to potentially hit this potential is perhaps to change the AA schedule somehow, right? That's something you'll talk about next week, right? If we have some way to change the AA schedule, perhaps upward, then we can actually hit this Y prime value somehow. And this is basically the toolkit that countries decide to peg their currencies to a fixed currency, such as Hong Kong. So Hong Kong has actually very good effectiveness of fiscal policy, precisely because they have to peg their currency to some value. And that means AA has to change, and AA changes, they could actually have a full realization of their output effect as a result, because their E has to stay the same. But in this case, E is lower, right? It's at as a much more appreciated value than before, right? So you can kind of see how bad things can get if we decide to do a permanent fiscal expansion. Changes in expectations go the same direction. And if changes in E matches the same level of expectation changes, the entire output effect could be completely undone, right? That's kind of a preview of what I want to show you soon. So to take the preview, permanent fiscal policy is not a good idea. And the reason because expectations change also in the same direction that makes the currency strong. And making the currency too strong could eliminate all export, basically all output effect overall. Okay. Maybe I just walk through it one more time, just to make sure everybody understands the sequence of logic and how fiscal policy works under the AADD framework. So what we try to do first was we try to conduct a temporary fiscal policy. Temporary means nothing happens to expectations. Fiscal policy expansion refers to two things, namely tax cuts or government spending. So if we increase government spending or decrease taxes, if we do the latter, we expand disposable income. If we expand the disposable income, aggregate demand increases, then Y increases, right? If we increase government spending, same thing, right? More consumption from the government, or more spending from the government increases demand, and output has to increase to meet those demands. With a higher Y, that feeds back into the money market equation, and that's going to increase liquidity demand overall. Okay, if we want to restore market clearing in the financial markets, then something has to happen with interest rates to undo the change in L. And that's only possible if interest rates increase. Interest rates can only increase if we have a stronger domestic currency. Okay. So with stronger currency, that's again feeds back here, right? With stronger currency, that's going to decrease Q, and that's going to decrease D, right? And that's going to decrease Y. And that's going to feed back here. Yeah. So to summarize what's going on here, we have E decreases, extra appreciation, feedback through CA, and decrease Y. So this is undoing this, right? It's undoing that. So that's why it's what's called a crowding out effect. That's the term that's used by economists. Crowding out, the CA effect. Because the current account is being undermined, so it's crowding it out through export. Less competition or more competition in the exports. All right, comments, questions on fiscal expansion. Okay, so you kind of already know what I'm going head towards next, right? We're going to talk about permanent stuff, and then trying to impose relative PPP. All right, so why should you care as policy analysts? I don't know, maybe some of you will eventually work for government institutions that track, or banks that track central bank decisions. But from a central banker's perspective, these tools are very important because you want to be able to quickly counteract certain changes in the economy that's coming, right? So in the case, imagine if people knew that the COVID-19 thing was coming, and central banks reacted fast enough, they could actually counteract completely the output shock that was caused by the COVID-19, right? So that's kind of where things, why monetary policy expansion becomes important under flexible exchange rates, because it's so effective. In fact, if it's surprising, right, as you'll see, if monetary policy is surprising or unexpected, that can have a tremendous output effect because expectations also change as well. But the problem with monetary policy and fiscal policy is that you have to be able to time everything correctly, right? If there's an output shock and you think it's coming, but it's not, and you do your monetary expansion, then you can just create volatility, right? Because expectations are wrong. Yeah. So assuming that you can time everything correctly, we kind of assume that in the UIP equation, right? Assuming you can time things well, then monetary policy can offset output shocks fairly effectively. And the reason because is the direction of Q is the same direction as you wanted to make your exports more competitive. For fiscal policy, it's a bit of a mixed bag. And the reason is because E is going in the opposite direction that you want it to do. If E is becoming stronger, exports becomes more competitive because your goods and services are becoming relatively more expensive. And as a result, output is ultimately undermined, right? So as I will show you, unanticipated fiscal shocks will have less strong output effects. Okay. The next slide, yeah. So problems, as I already said, problems with economic policy interventions. Interventions need to be timely. Okay. If you don't time it correctly, then you can create unexpected shocks, and investors will think of it as policy uncertainty in the future. And so E is going to be screwy. Yeah. Right here, right? So here, right? This is like kind of relevant now, right? The Fed was completely wrong about inflation being transitory in the US, right? And people kind of thought that interest rates weren't increasing as enough in the short term. And ultimately, I think people are still kind of uncertain of what the Fed actually believes and if they actually know anything. Yes. Anyways, as you already saw, right? Conducting expansionary policy during COVID-19 created a lot of inflation, and if they didn't respond to that inflation problem early enough, then you're going to have persistent inflation, right? Okay, so let's talk about the shift in the DD schedule and AA schedule under permanent policy. So unlike temporary cases, permanent policies means that if there is a change, that change is there forever, and therefore expectations also have to change, right? Monetary policy in the long run means that E is going to be more depreciated. For fiscal policy, if we do expansionary fiscal policy, E has to be lower. Expectations of E has to be lower, stronger currency, right? Another thing that we have to think about for permanent cases in the long run, we also assume that prices will be flexible, right? For monetary policy, with flexible prices, we will be able to actually impose relative PVP. Okay. For fiscal policy, however, we cannot make it true, and there won't be any sort of price impact, but we can't make it. We can't impose relative PVP. Again, we also assume that domestic prices do not influence foreign interest rates and so forth. Okay. So again, that just means that foreign policy changes in R star and P star has no bearing on what the domestic central bank decides. All right. So let me give you a preview of what you should see from the graphs. Okay, so for long-term effects of permanent increased monetary policy, I think the short-term effects you kind of already can predict what's going to happen, right? So just like the temporary case, you're going to have a shift in the AA curve upward, but because the E hat E is much higher than before, the money market equilibrium gap between left-hand side and right-hand side is going to be larger, and as a result, the E value, the domestic exchange rate, has to be much more depreciated than before. So you get a massive increase in E compared to just a temporary case, and that's going to facilitate output even further, okay, because your exports are more competitive than before. But the long-term stuff is a bit tricky because you have two things going on in the long term. Number one, we have prices being flexible, right? And number two, we have a persistent E hat E, right? Those are the two things you have to think about. And so AA schedule has to shift back, right? To some degree, it has to scale back. And you have to think about how that change feeds back into the area demand function, right? But in order for PPP to hold in the long run, it's possible to let P increase to the same extent as E, such that Q, the change in Q, or the percent change in Q, is zero, right? That's what it means to have PPP. So in other words, we're going to make the case that E will trace P, right? They move in the same direction. And because Q is defined as Q equals EP star over P, right? The change in P is going to be the same amount as change in E, and therefore, in the long run, Q will stay the same. Yep. So if Q doesn't stay the same, all right, so if Q stays the same as compared to what Q was before the monetary expansion, then we conclude that relative PPP holds, right? Because Q did not change. All right. But with Q not changing, that also means that no change in Y. Right? Because Q didn't change. If Q didn't change, then no output effect. And so the final equilibrium point in a permanent monetary expansion is just a more depreciated domestic currency and zero output change. Okay, so that's the long-term equilibrium, as you will see. So I kind of already described the short-term effects. So the reason why we get a much more amplified change in the spot exchange rate is precisely the same reason given with the overshooting thing, right? From week up to week 5. You get an overshooting because expectations also change in response to changing money supply. And as a result, the spot exchange rate is much more elevated than a temporary scenario. Okay. And so you get a much more amplified output effect, right? All the feedback and stuff. And yeah, and you get a reversion, right? The overshooting, right? The reversion as we go from the short run to long run. Because why? Because prices are responding, right, to the change in MS. So if P changes by the same proportion as MS, then E also moves in the same direction as well. And if that's the case, then Q shouldn't change at all. And if those conditions are true, then relative PVP will hold in the long term. Right? That's the takeaway. All right. Comments, questions on permanent monetary expansion. So that just means an increase in MS, right? Plus an increase in E hat E, right? That's the starting point. And then because we have changes in E, there's a long run effect and a short run effect that we have to analyze, and we have to therefore add an extra condition, which is flexible prices. So to go from short run to long run, we add flexible prices. So everything is coming together, right? We have not only the real economy now we're bringing all that analysis from up to week 6 into the analysis here, right? We have flexible, now we have from sticky to flexible prices, we have expectations changing, you will see the overshooting, you will see the reversion, and you will see finally that relative PVP can hold under this framework. All right, so maybe I just set it up for you and then walk you through it briefly, and then we'll take a break. So let's have a starting point. ED. Why not? And E naught. And let's also write out the equilibrium equations. Y minus T, EP star over P, and the money market equilibrium or financial markets MS equals P times L R star plus E hat E over E 1 and Y. So this is just the short-term effects. Short-term means that fixed sticky prices. So let's walk through the math, all right? So we have two things that's going on. We have a plus, we have an increase in E hat E, right? And we also have an increase in MS. So that means this term is increasing, and also this term is increasing. So with this term increasing, R is increasing, right? And therefore, so this entire expression is increasing. And L is decreasing, right? So with a higher left-hand side and a much lower right-hand side, then the gap between MS and P times L is very large, right? And in order for E to change, to close this gap, it has to move in a certain direction, right? It has to move in a certain direction that allows us to undo this decrease. This can only happen if R decreases, right? And R can decrease if E increases, right? So this has to go up so that L can go up. And because MS is also increasing a lot, this jump from this point to, for example, this point should be quite larger than temporary case, right? So if we're here, we are up to here. So remember I chose Y arbitrarily. This is Y not. In fact, I can choose any point in Y. I like to emphasize this because people get confused on how to shift curves. So if you choose any point along the x-axis, you must have a higher E. So every point shifts by the same amount. And that's why you get this upward shift in a curve. All right, so that means for this given Y naught, we are here, right? So let's walk through the chain of logic again for this permanent case. So let's do E naught, E prime. So with E prime, that's going to feed back through here, right? So higher E is going to create higher exports, so more demand for domestic goods and services. And we're going to have an imbalance, right? Left-hand side, right-hand side. And the only way to restore equilibrium is if the economy produces the supply, right? So Y has to increase. So we're moving along the A curve, right? Because that's what Y, moving Y to the right means, right? So higher Y feeds back into here, and then you realize with a higher Y, E doesn't have to be as high anymore, and so we are moving along the A schedule to this point here. So this is the final point, resting point in the short run. So let me circle that and call that S bar. So far, this is just review of the previous slide, right? So if I ever ask you to draw both temporary and permanent case in the same graph, you kind of know what to show you, right? You have to show that the A curve in the permanent case is much higher than the temporary case. All right. Comments, questions on the short-term effects of permanent monetary expansion? So I'll talk about the long-term effects after the break. All right, so I have a quiz for you again for today. Yeah, let me pass that out, and then we will reconvene in 10 minutes. Yep. Oh, Yeah.
We need full dump papers.
Oh, I will. I guess I missed the row. Oh. All right, folks, let's finish up. So I only have two more things to talk about, right, for today. The first is the long-term effects of permanent monetary policy, and then we have to analyze the case for permanent fiscal policy, and then that's it. Okay, so hopefully, if you can understand those three things, I'll be very happy. Okay, so short-term effects on permanent monetary policy, just to review, just to recap, is precisely the same kind of analysis you did with the temporary case. The only difference now is that you have two things moving, right? You have money supply, as well as expectations of the future spot exchange rate. With those things in place, you have an amplified effect of the change in the spot exchange rate. It's more depreciated, in which case you will get a amplified output effect. Right, and the mechanisms to achieve that output effect is the same as the temporary case. You have higher E that boosts, that makes Q larger, which makes domestic goods and services more attractive and competitive, and that's going to drive output, domestic output. And with higher output, that's going to feed back into the money market equation, and therefore the spot exchange rate is going to move along the A prime schedule towards this final intersection between the DD and AA prime schedule. Okay. Now the difference between that and long-term case is we now have flexible prices, and yeah, and E hat E matters. Change is persistent. So let me just quickly draw the curves that we had in the previous slide, just to make a distinction before or after change. And let me write the money market equilibrium here again. And also the real money, the real economy. Aggregate demand, what's money supply, aggregate supply. Alrighty, so what happens from the short term to long term? So between the short term and long term, we have prices increase, P increases, right? And R returning back to pre-shock levels, right? In other words, the effect of monetary policy is reverts. It has no impact on R, but because expectations have taken place, there's still a residual effect on the AA schedule. So the only thing that should be reflected in the AA schedule now is just E hat E, right? And so that curve is somewhere here, right? It's no longer at the AA prime level because we have flexible prices, but because UIP has changed, we still have an elevated AA schedule. So in other words, we go from AA to AA prime, and then now from long run to short run, because of flexible prices, we have this schedule here, right? And hopefully you can see that it's because P increases as much as MS, so these two effects cancel out, but we still have an elevated E hat E, which makes this have a gap between left hand side and right hand side. And as a result, you have to have E be at as high of a level to undo the effects, right? And so we still have a higher level E than before, right? Than this level. Sorry. I need to draw some extra lines here. So here is our starting point before the monetary policy expansion. And I'm going to emphasize this vertical line because that's when output returns back to its normal level. Okay. All right, so hopefully all of you understand why AA curve shifts back, right? It shifts back because P is flexible now, change as much as it changed for MS. And so those two things increase proportionally. And as a result, the only thing impacting the money market equilibrium is the change in E hat E. With that in place, UIP is still different than before. And as a result, E has to be at a higher level than before in order for UIP to be satisfied. But we have one additional problem, right? We have P also entering here, right? And we have E entering here. And so in the long run, we have prices increasing as much as MS, right? So that's higher. And also in the long run, we still have E increasing by as much as E hat E, right? So, cool, right? So if these two parameters move by the same amount, then there is no change in Q, right? No change in Q. So if we were to shift the curve, all else equal, let's just first, let's do, let's not look at the E. Okay, let's look at just change in P. So what happens when you change P? If you change P, all else equal, that's gonna make Q lower. And therefore D is also lower. And therefore this is gonna be less demand than what's being supplied. Too much supply, and so supply must be cut, right? So based on that fixed E, if we increase P, then the entire DD curve is shifting to the left, right? So if we chose this point here, right? Then this point should be shifted this way. Okay, so the question is, how much should it shift, right? And I want to convince you that it's going to shift all the way to this point here, in which output is 0. That's so the mechanism, right? The mechanism that's in place. Oh, sorry. That's the wrong curve. So it should be here. Should be here. Sorry. This is nothing. I'm just confusing you. Should be here. All right. So this is shift in DD holding E fixed, right? This must be true if prices become flexible. If prices reflect the change in MS by the same degree, then in the long term, as we transition from short run, which is this point here, right? It should be this point, sorry. This point here, then this point should shift this way, right? But as we shift output down, we should be moving this way towards this point here, right? And this is coming from sorry, maybe those arrows don't make sense. Sorry. Okay. It should be actually this point here. Yes. Because E is moving by the same proportion as P. And it's going to do so until Q is constant. And when Q is constant, there's no output effect between pre-shock levels to post-shock levels. Long run levels. So this point here is your long run effect. And this point here is your short run effect. So it's clear that for a given E, let's say it's this point, we should be moving towards the left, right? Because output should shrink. But as output shrinks, right? But as output shrinks, then your E is going to move at a higher level, right? And it's going to do so based on our analysis up to week 5, such that the change in E is going to be by the same proportion as the change in P, in which there's no change in Q. And based on the long-term condition, when there's no change in Q, we have relative PVP holding no longer. No longer. So in the end, you get a more depreciated domestic currency. Not as much as the short run, right? That's this one. So you do get a reversion, right? You go from here to here to here. So hopefully you see everything connect now. So you get this long run reversion from the starting point here, overshooting because we have expectations also changing. So we have a short run equilibrium, but again, no flexible prices. And and both money supply, real money supply having an impact on interest rates as well as expectations changing, which will change E, right? And so you get this amplified effect from E naught to E prime. You get this reversion because in the long run, flexible prices means that monetary policy is not effective on interest rates, but because expectations have changed, UIP equation has changed, and as a result, you must have a different E than before, right? That's as reflected by this AA double prime here. The final realization is that with higher prices starting from the short run, you must have the DD curve shifting to the left. And the question is, how much should it change, right? How much should it change? Well, it should change as much as the change in E with respect to prices. So if E changes as much as it changes in prices, as we learned from up to week 5, right? E traces prices, then Q doesn't change in the long run, right? Because this is the same Q. This is the same Q as we started at Y naught. In which case, our final ending point is here. Okay. So the ingredients again, increase in P, right? That's the starting point. So if this is going from short run to long. I mean, let me do a side-by-side comparison. Okay. So the short run. And then we do a long run somewhere else. Okay. Short run. Short run. We have increase in MS, which will lead to an increase in E. And we have an increase in E hat E, which will also lead to an increase. Right, that's where we get the amplification effect. The long run, we have two markets that respond to the change in prices. For the AA curve, we have increase in P, which will decrease E. sorry, increase in P. So I don't want to confuse people. The decrease in E is going from this curve here to this curve, okay, right? The entire E is no longer as high as possible. So that's what I mean. Okay. I hope that's clear, right? So it's just the shift in the curve. Okay, it's not anything else. And for the DD curve, we have an increase in P that leads to a decrease in Q and therefore decrease in Y. And we're saying that Q decreases all the way back to its starting point, its initial Q level, because we assume we showed it up to week 5 that E traces P. And when E changes as much as P, then there's no change in Q. And as a result, no output. And now I have to put this somewhere so that people don't get confused. Okay. And let's move this here. Sure. All right. So long run, you just have to think a little bit about what happens to prices. How does price change affect AA? How does price change affect DD? And then to identify the final resting point, you can also try to impose relative PVP, which we did. If E traces P by the same proportion, right, then there should be no extra output coming from the current account. And so in the end, just like the short run analysis, you get no change in Y, obviously, and a final elevated E than before, right? Because E double prime is still higher than E naught, right? So ultimately, you still have a depreciation of the home currency. Comments, questions on long-term permanent monetary expansion? Again, the difference is just you have to think about P. I will go over this again at the end of class again. So I have my review slides, and I'll go over the sequence of logic, the chains, and also the exit parameters to think about in the long run. Permanent fiscal expansion. So let me give you a preview of what to expect. The takeaway from a permanent fiscal expansion is that it's not as effective as monetary policy. And the reason is, as I mentioned earlier, in the short-term analysis, it has a secondary effect on the exchange rate that undermines output, right? From being your domestic output being competitive. With a stronger currency, that means that foreign domestic goods and services become relatively more expensive compared to foreign goods and services, and therefore everyone, including the home country, would prefer to import as opposed to our own goods and so forth, right? And this is already a problem, right, under the temporary case. But when you have a permanent case, that means expectations move in the same direction. And with expectations moving in the same direction as the change in your spot exchange rate, you're going to get an even more crowding out effect coming from a stronger currency. Okay. And because of this, PPP will fail not only in the short run but also in the long run. Okay, because Q is depreciated not only because of Q is appreciated than before, right? So there is a change in Q compared to the starting point. And it's coming from the fact that the home currency becomes stronger, right? It has to be stronger, both in the short run and the long run. Okay, so short-term effects and long-term effects are basically the same, as I will show you in a very special case. So I want to talk about a special case because I want to show you the case in which I want to show you the case in which the entire output is wiped out. This requires to talk about a scenario in which R equals R star, and also, in other words, E hat E minus E over E is equal to 0. In this special case, in which R equals R star, you will have a if you do have a fiscal expansion, that fiscal expansion will have that fiscal expansion will have a 0 effect on output, and it must be true. Otherwise, you get a contradiction. So the way to prove this is through a proof by contradiction. I don't know if any of you have taken math classes, so sometimes to prove something in math, you can go, one way to do is a direct method when you make some assumptions and you build off those assumptions and you arrive at a conclusion, right? That's kind of deduction. There's another way to prove things is when you assume something that you know is wrong, and that assumption contradicts another assumption, and therefore you must conclude the opposite. So the way to prove that fiscal policy is completely ineffective in this special case in which R equals R star is to do the same thing. We're going to assume that there is an output effect, and then try to draw conclusions that contradicts one of our assumptions, namely UIP, right? The way that we assume how market clears in the financial markets. Okay, so let me walk you through the proof, then show you the graph, and then show how the proof that I walk you through corresponds to the graph, right? So what we first want to do is just assume something we know is wrong, okay? Or I told you it's wrong. So we're going to assume that in the short run, there is in fact an output effect arising from fiscal expansion. So suppose we increase government spending, we cut taxes, and there's somehow magically there is an output. Okay, so we want to draw some conclusion because of this fact. All right, so I want to first claim that if we assume there is a positive change in Y, then it must be true that the change in E hat E will not be the same as the change in E. In fact, the change in E is going to be more positive, okay, than E hat E. So in the special case in which you have R equals R star, what I'm saying is that if the decrease in E, so again, it's a decrease because we're talking about the currency getting stronger, right? So if the drop in expectations in E hat E is more severe than the actual drop in the real spot exchange rate, or just the spot exchange rate, then you're forced to conclude that E hat E minus E is negative, right? Again, the reason because the change in E hat E is more negative compared to something that's less negative. So something that's more negative minus something that's less negative is going to give you a still negative answer, right? Okay. But we also know something else from our short run model, right? So remember this. So when I refer to the short run model, I'm referring to this graph here. This is E and this is L, right? And this is R. When we have an output effect, we have a outward shift of liquidity preference function, right? And as a result, we have an increase in interest rates. You concur? So this is R prime, and this is R. And the reason why we get a decrease in E is because the change in R is now greater than R star, which means that E hat E minus E is positive. Do you agree? So remember, we're starting with this assumption. Okay, so we're being very precise with this special case. Okay, so this is a special case in which R equals R star. Okay, I want to first propose, I will show you graphically, that if we have a positive output arising from a fiscal expansion, then the drop in E, the spot rate, is going to be less than the drop in long-term change in E. Okay, this must be true. You know, I'll show you in the graph. In other words, that's like saying that E hat E minus E is negative. That's number one, right? Number two, we also know if there is an output effect based on the short run model, that's going to lead a conclusion about the UIP equation, right? Because if there's an output, we know from the money market equilibrium, there must be higher interest rates, domestic interest rates, and with higher domestic interest rates, you're going to have the new domestic interest rates being higher than foreign interest rates, which you must force to conclude that the expected depreciation of the home currency must be positive, right? To offset the gap. But these two statements are they can't be reconciled, right? One says the difference is positive, one says the difference is negative. So these two things cannot coexist. And so our initial assumption that there is in fact an output is wrong, right? You must conclude that it's wrong in this case. Right, so we reached the contradiction. So our initial assumption that there is in fact an output must be false. So we must force to conclude that total output of a permanent fiscal expansion under this special case is 0. That must be 0 in the short run as well as in the long run. So let me walk through the logic again, and then I'll go through the graph. So the way we prove this is, again, it's indirect, right? In mathematics, I don't know how much math you have, but in mathematics, we typically prove things by making some assumptions, drawing some conclusions, and then building off those assumptions to arrive at a final conclusion, right? Like the law of transitivity, right? Same thing, right? If A is greater than B, B is greater than C, then we must conclude that A is greater than C. But this kind of proof is a bit different, right? We want to assume something first and see if that assumption is feasible. If it's infeasible, then we know for a fact that that assumption is wrong, and we must conclude the opposite, right? That's kind of what we're trying to do. We must assume something first and see if that assumption leads to a contradiction. And if so, then we know that initial assumption is false, and therefore the complement or the opposite of that assumption must be true. So first things first, we assume that a permanent fiscal expansion must lead to a output effect. And the only way for that to be possible in this special case of R equals R star is if the E value, the spot exchange rate, decreases less than the change in expectations. In other words, E is a higher level than E hat E. Okay, so they both can be very positive numbers, but E decreases to a level that's higher than E hat E, and therefore a small number minus a big number, right, is going to give you a negative number. All right, so this must be true. Yeah. What you should conclude is that E and E hat E must actually change precisely the same, right? Just like in the previous example. But in this case, we're assuming that there is a difference between the change in E and a difference in the change in E hat E. And therefore, the final level of E versus E hat E must be non-zero. In fact, it should be negative in this case. That's the only way in which you can get a output effect with a permanent fiscal policy. So that's number one. That's the first assumption or conclusion you should draw from that assumption we made about an output effect. Number two is based on our model of UIP. So based on UIP plus money market equation, you know that if there is indeed an output effect, given that our starting point is R equals R star, we must actually have higher interest rates. And with higher interest rates, there's going to be incentives for carry traders to come in to investors come in to conduct carry trade, right? And what that means is that the expectation of the expected depreciation of the domestic currency must actually be positive, right? Because R prime is greater than R star. Investors are only willing to conduct carry trade if E hat E minus E is less than is equal. I mean, it doesn't close the gap. But if there's a gap, then that means that the gap is closed only if E hat E minus E is positive, right? The gap can only be closed if E hat E minus E is positive. So long as there is a gap, carry traders come in and they'll keep doing this until E hat E minus E is positive, right? Conclusion 1 says this difference is negative. Conclusion 2 tells us that this difference is positive. These are two things that cannot coexist, right? It's contradiction. You can't have two things that are it's like being in the same place, two people in the same place at the same time. It's impossible. So we must therefore revoke our initial assumption that there is indeed an output effect. And so based on this special case, a permanent fiscal expansion must lead to a zero output effect. And the only thing that should come about is just a appreciated domestic currency, right? Zero output, stronger currency, relative PPP can't be true anymore in both the short run and the long run because Q is different. Q has changed. All right, so let's take a look at what that looks like graphically. We have, again, I'm doing this special case. So if I ask you something about this on the exam, you can go ahead and do this special case. I won't ask you to do like a generic case, just to make everyone's life easier. This is MS equals P times L. And the DB curve is and I'm going to draw this vertical line just to emphasize that it's an important line because that's where we started from. So I'm going to write Y bar to distinguish from a generic Y naught because this is the case in which R equals R star. Okay? So in this case, when we do fiscal expansion, the shifting of the DD curve is the same, right? Let's walk through the logic, right? If we have increase in G or an increase or decrease in T, right? That's going to increase D and distort, making D greater than Y for a given E. And the only way to restore equality is if Y increases, right? And so for any choice of E, so let's just do this one. Let's call that D dot. This point must shift to the right, right? In fact, any choice of E is fine. You'll discover that DD must shift to the right. So let's do this point here, right? Okay, so now problems, right? Problem arises because it comes from here now, right? So just to emphasize, you not only E hat E will decrease, but but E decreases by how much, right? That's the question. So we know that with a higher E hat E, sorry, lower E hat E, stronger currency, we know the currency is going to get stronger, right? People expect the currency to get stronger because under the temporary case, we get a stronger currency. So E hat E is going to get lower, which means interest rates will be lower, which means that liquidity preference will be higher. This will make the right-hand side greater than the left-hand side, and the only way to restore it is if E gets smaller, right? To undo everything. And we're saying that E doesn't decline as much, right? If E doesn't decline as much, then we're talking about like the scenario like this, right? Maybe it decreases by this much, right? Maybe just a little bit versus the actual, right? Our proposed, as we proved in the previous slide, right? We want to show that E decreases by just as much as the change in expectations that wipes everything out, and therefore we have no change in output, right? That's kind of what we want to say. But we're saying, well, maybe E doesn't change that much, right? Maybe it's somewhere here, right? So there's in fact a positive output. Yeah, do you agree that this gap here is a positive output, right? So the only way there's a gap is if E doesn't change as much as E hat E, right? Exactly what I stated here. If E doesn't change as much as E hat E, then the value of E is still larger than E hat E. And so the difference between E hat E minus E is going to be negative, right? So after we hypothesize this point, right? That's our hypothesis. We can therefore go through the chain of logic, right? E hat E minus E must be negative because the E value didn't decrease as much as the E hat E value. So E hat E, a small number minus a big number, is going to give you a very negative number, right? Some negative number at least. Cool. So we have an output plus a negative difference between E hat E and E under this special case. And then we walk through this short run model logic, right? In which we assume that there's an output effect, which requires higher domestic interest rates, which actually requires a higher depreciation of the home currency, right? If there is a gap between R prime and R star, then we know that there must be a compensation from the depreciation of the home currency, and that requires the gap between E hat E and E to be positive. These two conditions cannot simultaneously coexist, and therefore our initial assumption of having an output is wrong. And so A prime must decrease until we have nothing. We have zero output. And all we have left is just a stronger currency and zero output. Okay. So this point here is our short run and long run. And if you look at Q, right, we can look at Q equals EP star over P. Prices didn't change, right? No sticky prices, nothing happened. All that did change was change in E. So that's this point here. That's down. Q is down, and therefore, in both the short run and long run, Q can't stay constant, and as a result, relative PPP is broken. Can't be hold true. All right, comments, questions. So let me go over this one more time, and then I'll go over again in the final review slides. So to emphasize, I am analyzing the permanent fiscal expansion policy from a very specific point, just to show you that the ineffectualness of fiscal policy under flexible exchange rates. So I highlight that we're talking about flexible exchange rates, meaning that there is no government or central bank policy to make sure that your currency is pegged to a certain amount, or there's no manipulation of the currency. It's free floating. Central banks' only duty is just to expand and contract money supply to hit those internal governance conditions, right? Those full employment and stable prices. They don't care about exports, imports per se through the spot exchange rate. All right, so under flexible prices and under this special case, we want to show you that permanent fiscal expansion will lead to zero output change. And this must be true through what's called proof by contradiction. It's called proof by contradiction because we're assuming something first, and that assumption will lead to a contradiction based on a pre-assumption that we made beforehand, namely the UIP equation, right? UIP plus money market equation. So the way it works is we first assume that there's indeed an output. Suppose there is an output. Based on this graph, it should be easy to see that if expectations change, E must change by the same amount, right? In order to restore money market equilibrium. But suppose we don't, right? Suppose we don't let E change by the same amount to restore equilibrium. And therefore, an output is only achieved if there is a gap between Y bar and something to the right of it. If that's true, then that means that E, the spot exchange rate, didn't decrease as much as the change in E hat E. And so we end up with a difference between E hat E and E that's going to be negative because E is still a larger number than E hat E after the change. Okay. So that's number one, right? Just based on this graph, right? Based on this graph, you should easily see that in order to get output, you must have E not moving as much as E hat E. Okay. Number two, based on the model we've learned up to week 5, 6, we learned that if there is an output effect, right, there's an outward shift of the liquidity preference curve, then interest rates must increase. With higher interest rates, that's going to change the spot exchange rate because investors, risk-neutral investor, will want to lend at or borrow at low interest rates and invest in a higher interest rate, right? Namely, invest in the domestic currency. Okay, this is only acceptable in equilibrium if there is an offsetting depreciation of the home currency, according to UIP. Right? Equilibrium is only achieved if there is a depreciation of the home currency that wipes out interest rate differentials so that carry traders earn nothing. This conclusion cannot be simultaneously true with this conclusion. Right? And so our initial assumption that there is an output effect, namely there's a gap between Y bar and something to the right of it, cannot be true. And so we're forced to conclude that there is no output at all. And that's precisely this point here. So AA schedule and graphically must decrease to the point in which you get nothing, no output. And all you get is a stronger domestic currency. The side effect is that we cannot impose relative PPP. Relative PPP cannot hold in both the short run and long run. So for this graph, I wrote C previous graph because long run and short run are the same thing, right? You don't have to think about prices. For the case, again, this is for R equals R star, right? As a starting point. It's a starting point. All right. Summary slides. under floating exchange rates is the conditions I've been kind of reinforcing since the beginning, right? We're talking about a system of countries that don't monitor their exchange rates, and they can freely conduct open market operations without thinking about what the spot exchange rate should be. And this must be true for both the government spending perspective as well as from the central bank's perspective. And based on this floating exchange rate environment, we should draw some conclusions about the effectiveness of one of the policies or both of the policies. For monetary intervention, we find that it is very effective, right? The reason because is there's a weakening of the currency that actually facilitates output, right? If you create money, and that's going to lower interest rates in a direction, right? That's beneficial for exporters, right? And that's going to lead to a higher Q. With higher Q, higher current account, higher output. Great, everything goes the same way. And in fact, if you do permanent monetary policy, things get amplified. As compared to fiscal policy, it's less effective, right? Because of this crowding out effect coming from the current account. Your currency gets stronger from a stronger output. And with stronger currency, your exports are less competitive because currency is stronger, right? And therefore, people don't want to convert the currencies to your home currency and buy your goods and services. So foreign goods and services are more attractive. And that's going to crowd out your output effect. So output is undermined in this case. Things get a lot worse for the permanent case, right? For fiscal policy. Permanent fiscal policy. So based on the special case in which R equals R star, I showed you that output is completely wiped out. But of course, we're usually not in this scenario where R equals R star. We're usually, R equals R star plus something else, right? But the point I want to put forward again is that it is significantly undermined if the fiscal policy is unexpected. So you don't want unexpected fiscal policy under flexible exchange rates, because with stronger currency, that's going to crowd out completely or significantly portion of your total output from your government or tax cut, government spending or tax cut. And again, highlighting the effectiveness of monetary policy. It is very effective in the short term for under flexible exchange rates. The reason is because everything goes in the right direction, right? Expectations change, that only amplifies the depreciation of the home currency, which is great for exporters. So not only do you get an output effect because people don't want to hold on to cash. I mean, don't want to hold on to they don't want to put their money in deposits or long-term deposits anymore. They want to spend, but you also get an export effect coming from a higher Q. With higher Q, that drives D, and output's going to increase and so forth, right? All right, so that's the takeaway for this set of slides. So under flexible exchange rates, there's two policies to consider, given that we expanded our model now to incorporate the real economy. One is fiscal policy, and the other is monetary policy. Monetary policy is great under flexible exchange rates because whenever they conduct open market operations, everything gets amplified if things are unexpected. The reason is because the change in expectations actually helps us in terms of imports-export competition. But when it comes to fiscal policy, things get tricky. The reason because is when you do fiscal policy, your currency actually gets stronger, and that actually undermines import-export competition for the domestic country. And so there's this competing effects, right? Competing effects, and it's possible that the negative current account effects crowds out the positive output effects that you want from government spending or tax cuts. Okay, cool. Comments, questions on this set of slides. So I think next week is going to be the final set of slides on exchange rates determination, and then we'll move on to risk management. All right, so let me summarize today's what we learned today. So the objective of last week and this week is to expand the model so that we can think about an additional source of policy coming from the government, through government spending and tax cuts, right? And that requires us to construct a DD schedule, which we did. And for today, we want to talk about analyzing, those fiscal policy choices and how that changed the so-called AA and DD schedules, right? So the ingredients are the following. We have to assume that exchange rates are floating, meaning that there's no manipulation or management of the exchange rates. Central banks don't care if the exchange rate between the dollar and Chinese yuan is 7, 8, or even 1-to-1. They don't care. And prices are sticky in the short term, which means that we allow PPP to fail in the short term, but we will try to impose PPP when we can in the long term. And we also assume that there's independence between foreign interest rate policy versus domestic interest rate policy. So just because the EU or the Bank of England decides to cut interest rates doesn't mean that Fed is going to do the same thing, or the PBOC. Right? So let's decide what the interest rates should be independently of each other, which I don't think is an unreasonable assumption. Okay, plotting, and finally, we're plotting E against Y. So that's the reason why we're focused on this, because we want to know how changes in E can ultimately change in Y, because as you know, next week, sometimes central banks want to target E at a certain level to achieve a certain import-export goal. Okay, and if that's the case, which can allow a country to expand or grow their productivity, that's fine. But I'm just showing you what YE here. I'm trying to show you the mechanism in which E is related to Y. The DD schedule I outlined for you in the past 2 weeks. Y equals D. D is just the GNP equation, right? C plus I plus G plus exports. But here I reduced it to the core parameters that you should all be thinking about. Disposable income, which is post-tax consumption power, Y minus T. I, which is investments, which we assume to be held constant. G, government spending. And Q, which is a parameter, the key parameter in the current account, which describes import-export incentives, right? So if you're higher Q, means foreign goods and services are more expensive relative to home goods, in which case all other foreign countries will try to import from you, and therefore you will have every incentive to produce more, okay? If you want to shift the DD schedule, the rule of thumb, again, is if it's not E and Y that's changing, then the curve has to shift, right? Because if you change E, then you change Y, then you're just moving along the curve. But in the case in which you're changing something that you don't see on the axes, then the curve has to shift. The key parameters that we're thinking about changing is G and T. And G just means increased government spending. That's like making investments to build the internet, for example. T, usually we think about tax cuts, so going the opposite direction. But either case, increasing government spending or tax cuts will lead to a increase in output for a given E. So the logic here is you fix E, and if you change a parameter, you have to conclude, well, does Y increase or decrease? If Y increases, the DD schedule shifts to the right. If Y decreases, then the DD schedule shifts to the left. The A schedule, the way to think about curve shifting is the same, okay, except we fix Y. So for a given Y, if we decide to increase money supply, then E has to move in a direction that restores parity or equality, right? In this case, if we have increase in money supply, we all know that E has to increase, and so the A schedule shifts up and down because we're changing a parameter that's not on the axis, right? So MS is not on the axis, R star, E, all these parameters are not on the axes, right? It's not E, it's not Y, and so the A schedule has to move up and down. right? So the key thing to note is perhaps something to think about is, well, the entire function could change in which a country becomes more sensitive to its changing parameters. So that's something interesting to think about, right? So there is a homework question on this. I will post it either tonight or tomorrow. So think about like small countries that become wealthy and they have preference changes, and that could change to the change in the response to Q to CA, right? For example, imports and also liquidity preference, right? Okay, so those are the ingredients. We analyzed a temporary monetary expansion today, in which we increase MS, and we kind of follow the logic of how MS translates to a shift in the A schedule and how things change and why can ultimately feed back into the DD schedule, right? The aggregate demand function. And the feedback is represented by moving along the curve, right? That's the kind of takeaway here. So as we increase E as a result of the increase in MS, that feeds into the DD schedule, which increases Q, and therefore Y has to increase as a result, which again feeds back into here, right? And this keeps going over and over and over again until all markets clear, meaning that producers don't want to produce anymore, demand is satisfied, and investors don't want to conduct carry trade, and money supply equals money demand, right? In which all markets clear, then we've arrived at a combination of E and Y in which AA schedule that is on both the AA schedule and the DD schedule. Okay, so these two things are the feedback. Okay, so what does that look like graphically? It looks like this, right? We increase the AA schedule up here, so we're at this point here, and as this point here feeds into the DD schedule, and the DD schedule changes, and that means Y doesn't have to be as high anymore, and so we're moving along the A prime schedule until we reach a point in which all markets clear. Nobody wants to change. All right, for temporary fiscal expansion, the AA schedule is not changing, right? What's changing is the DD schedule first. And that can take in the shape of government spending or tax cuts. Now remember, I'm using C as a parameter to indicate it's the tax cut portion that people are using for consumption, not for savings, okay? So with either of these effects, you will get a disequilibrium in the real economy. And in response to restore market clearing, you must have higher output. So again, G and T are not on the axis, so the DD curve must shift, right? But the shift in the DD is going to cause a chain reaction, right, in the other equation. So with higher Y, feeds back into the money market, distort the equilibrium, and that forces us to decrease E in response to the Y, right? And that's going to feed back into aggregate demand equation again. And so there is a counteracting effect. You can see it, right? Conflicting effects here. One pushes Y upward, but having a stronger E pushes Y downward. So you get this tension from fiscal policy under flexible exchange rates. And what you get is what's called a crowding out effect, because export competition, your domestic export competitiveness has declined. And so that effect is crowding out your total output effect. So what does that look like? It looks like this. You have DD curve shifting to the right because of government spending or tax cuts, right? That's this shape here, but you don't get the full realization here because your currency has to get stronger, right? So for this given output level is unacceptable because it's not on the AA curve, right? So we have to move toward the AA curve, but as Y goes this way, right? E is going to get stronger still. So in the end, we are at this point here, right? So this is the full potential, right? And this is the actual output. Right, and this point is the starting point. All right, so that's I hope it's clear that you see that the full potential of the output is not realized, right? It's not a 1-for-1 increase in output. It's actually much less because of the strengthening of the home currency. All right, permanent fiscal monetary expansion. Just like the temporary case. So I'll show the graph because I think it's. Did I even show the graph? Okay, yes. So here's the graph. So I'll show you the graph, and then I will show you the permanent case. Yeah, show the graph. So I think it's fairly clear. So what you do is the short term is just like the temporary case, but it's amplified. So you have an E value that's much higher than before. So you jump to here. The reason why it's so amplified is because E hat E is increasing just as MS is increasing. But when we transition from the short run to long run, prices have to increase. Prices increases means that monetary policy has no impact on interest rates. So AA prime must drop down to here. Agree? And you also have prices increasing in the DD equation, right? So if prices are increasing, and as price increases, we also know that E has to increase by the same amount. And if we were to impose the relative PPP condition, E has to move as much as P until Q is the same as before. And that's precisely this point here. So the takeaway here is the flexible exchange rates makes monetary policy very effective, especially if it's unexpected. And actually that also coincidentally is consistent with relative purchasing power parity in the long term. But for permanent fiscal expansion, it's tricky. The reason you can already see from the temporary case in which there's competing effects coming from the strengthening of the currency. And in the special case in which we're starting with R equals R star. So this is another way of saying R equals R star. You cannot have an output effect because otherwise you will get a contradiction in the model we're using, and also with the way in which the AA schedule has moved, right? So again, let me just show you the graph so that it's clear. So in the permanent fiscal expansion case, we have DD curve shifting to the right. I think it's clear. But the question now is because E hat E must go down. If that's the case, how much does E has to go, right? The same or less? If it's less, then it's going to be some line here. Of course, that's going to give you some output that's positive, right? This is a positive output. This positive output means that E hat E dropped more than the drop in the actual spot rate, in which the gap is going to be negative, right? You must have E hat E minus E being negative. But based on our short run model that we work with up to week 5, we know that as output increases, the liquidity preference curve shifts outward, which means that interest rates must be higher, which means that investors will want to conduct carry trade unless there is a offsetting depreciation of the home currency that wipes out the interest rate differential, right? In other words, E hat E must be greater than E, or the gap between E hat E and E is going to be positive. These two conditions cannot coexist. So the conclusion is there shouldn't have been any output to begin with. So that's the only conclusion you take away from this permanent fiscal expansion. So in the end, in the short run and long run, you must conclude that output is basically nothing. It's nothing there. And you ultimately only have a stronger currency. All right, so that's all I have for you today. So we're almost done. I feel like we're kind of moving too much macro and less finance and accounting. So I promise you next week is the last day, and then we'll move to basically all finance. Okay. Anyways, next week we'll conclude on the trilemma, which maybe some of you have seen before. So we'll talk about the trilemma, and then we'll talk about other exchange rate regimes. So far only floating exchange rates, but because we're in Hong Kong, I have a obligation to talk about fixed exchange rates and what that means for fiscal policy and monetary policy. Okay, so after that, we're done. And then we'll move on to risk management topics. All right, so if you finished your quiz, you can turn them in up front. Happy to answer questions. Otherwise, I'll see you guys next week.